Welcome back, investor. We are live tonight and we are going to be covering, and in this next hour, we're going to spend together passive income, what it is, what it isn't, and how you can use your retirement account to build passive income so that you can afford to retire early. Get out those retirement accounts when you're 59 and a half. And so a lot of people are thinking to themselves, if I want to retire at 50 or 55, how am I going to live between 55 and 59 and a half when I can start getting at those retirement accounts? So people are also tend to plan their retirement around that, like 59 and a half, 60, 61 kind of an age. So whether or not you want to retire at 50, 55, or you want to retire at 60 or even 65, we're going to talk about how to actually retire at any age that requires having passive income. We cannot retire if we are still working. Now, we can be working in retirement, but we could be not working. And that's the definition of retirement. If you could afford to not ever work again and you work by choice because you're interested in it or because you just want a little extra money to grow or do some fun stuff. There are lots of different reasons that people choose to work after they're financially free and technically could retire and choose not to. But what we're going to talk about tonight, whatever your motivations are there, we're just going to be able to say, whatever you want to do, whatever your plan is, whatever your lifestyle design is, we're going to figure out how you can pay for it. And then you can have the freedom and the creativity Welcome back, Emma. I apologize that I lost internet connection there for a little while. So let's just start this over from the top. Welcome back, investor. We're going to be spending an hour together talking about what passive income is, what it isn't, and how to be able to use our retirement account to be able to generate passive income that we need to be able to retire. That's what retirement accounts are for. Now, for those of you who know already, 59 and a half is the age when you can start to access those retirement accounts. But a lot of people want to retire, 60, 65, that's going to work. But many of our investors prefer to retire at 50, 55, and they're wondering how they're going to be able to survive on passive income for those years between when they actually want to retire and when they can access those retirement accounts. And so we're going to talk about that a little bit, having the power of that retirement account once you've reached that 59, 60 years old, and then a couple of strategies that you can also use if you'd like to retire a few years early, and how you're going to be able to afford to not work during that time that before you can get those retirement accounts. Now, whether or not you want to travel or you want to work after you retire or you just want to sit on a beach in Mexico, it doesn't really matter. I think that lifestyle design and those questions we ask ourselves is really important so that we can have that why we're doing this, because it's a difficult road. And so having a strong reason why you want to do something it's important to think about. But in this particular presentation, we're going to be talking specifically about the how. The why is probably more important because you're willing to do the research and get into it. But for those of you who are here, you probably have already thought about these things. You probably already have those goals set. And now you're figuring out, all right, how do I get this accomplished, this desire that I have to create this lifestyle that I'm going for? So if you are listening to the audio, I'm going to be sharing a free booklet that you can get. I'll put a link down in the notes of where you can download this. Sorry, we got no sound. Can you hear me? I'm not sure if there's only one person that can't hear me or everybody can hear. All right, perfect. All right. If you're watching on YouTube, I can hear you. There's no sound video perfectly. Okay, awesome. So it looks like most of us can hear us. You might want to check your sound settings in YouTube and make sure that your YouTube is not muted or that your browser tab is not muted. And hopefully then, well, if you can't hear me, you can't hear those instructions. All right, so I'm sharing a booklet with you. I will put a link on where you can download the booklet. Again, if you're listening to the audio, I'll try to describe what we're looking at and read it a little bit, but you can also download it with the link and get a copy of it and follow along as we're going through this together. If you're watching on YouTube, obviously you can see it right in front of you on your screen, and that should be able to help us as we kind of walk through this process. So starting out with the tax-free IRA investing to build your dream life. That's kind of what we're talking about. When you want to retire, what you want to do when you retire, that is totally up to you to decide, and we're just going to help you figure out how to pay for it. Starting out, what is passive investing? And you can make this bigger if you need to. You can zoom in if you need to. Passive investing is not an official financial word. It's not like you're going to go to Investopedia and look up what passive investing is. It's a colloquial term that people just use to describe that money is coming in and you're not having to work for it. Because it's not an official financial term, it can mean different things to different people. So I'm going to define passive investing in the way that I use it and the way that we're going to continue to use it throughout this presentation. And my definition, of course, is the best definition because this is what makes the most sense to me. So passive income is when you have your money invested in a business or activity that is generating income and you do not work in that business or for that business. Upfront to earn and which business you want to invest in. But once you invest the money, you no longer have control over how it's used, business decisions, you don't vote, you don't have any control. It's literally going to the business to use as they see fit, and then they will return to you your returns or hopefully your gains when the business performs, and they will pay you for the right to use your money. So they're paying you to use your money for their business activities. It is not a hands-off business. It is not starting a business that you don't have to work at every day. One good example would be like an online course where you create an online course, you create it once and sell it again and again. And you're running. But if you're in charge of the business, the LLC is in your name, you are the chief marketer, you are the person who's actually creating the product and putting it out, then that could be a low maintenance or hands-off business, but it's not passive. It's not passive income. So the way we're defining it is when your money is working and you are not working. Financial freedom, again, is not an official financial term, but it is when your income now pays your base bills. Like you can now not work and you don't have to worry about your mortgage, your food, your car, your clothing. Maybe you have some left over to take vacations, things like that. And this is one of the reasons many people choose to keep working after they reach that first level of financial freedom. It's because now they don't have to worry about their bills anymore, but they want to continue to grow it. And the best way to grow it is doing something where you are generating income, making money out of thin air. That's what working is. So the money doesn't already exist. You did something, you sold a service, you provide value to a company, they pay you for that, and then you are then able to go and invest that generate passive income. So again, financial freedom is kind of a low level term, just saying your bills are paid and you could choose to not work, but you may choose to because you have some interesting project or because you would like to earn a little bit more money to continue to invest so you can live on the passive income that you already have, but you're going to make more to continue to invest so you can grow that. And you can have an even better lifestyle, or maybe just a little bit more security so that you can volunteer or do other things like that. It's really up to each individual person. Retirement does not mean that you're no longer working. And it certainly doesn't mean that you're going to lose your purpose. And that's one thing we talk about a lot is making sure that you understand why you're doing this so that you have the opportunity to figure out maybe a new purpose or to continue with the one that you already have, but not having to do it for money, doing it for personal fulfillment reasons instead. So your retirement account, your IRA, can be used for real estate investing. I'm going to expand that out saying your retirement accounts can be used for private market investing in general. Private markets are anything that's not publicly offered. So when a stock goes onto the stock market, it has an initial public offering, and that has gone through the road show to get that out, the process of verifying that stock, registering that company to be able to offer public stock. And public means that anybody can invest in it. A 16-year-old kid could be investing in that thing. It doesn't matter how much money you have, how old you are, anything about it. It's publicly available, and it goes through some stringent requirements to be able to be on the public market. So that's the stock market as we all know it. Public bonds, like public credit, would be like corporate bonds, things like that. You can also buy. These are publicly traded. That's what that means. Most companies are privately owned, and so real estate can't be traded in public markets. And so there's a misunderstanding when you're investing in a REIT or a real estate investment trust that is diversification into real estate, but it's not a real asset. You're still investing in a paper asset. You're investing in the trust company that holds real estate, and you don't have any direct ownership over that real estate. If you're in a private real estate syndication, even if you're a limited partner, meaning you don't have any decision making, any control, you do your upfront research, and then once you let the money go, it's kind of like when your kid graduates high school and you're like, there you go, I've taught you, I've done the work, and now you're off to do your own thing. You are still having direct ownership in that property itself, so that even though you're not making decisions, you are a limited partner, but still a partner. It's a little bit different than investing in a trust company that owns real estate. So to get into real estate, you really either need to own it yourself, or you need to buy into it in some sort of a group where you can be truly passive. People talk about real estate being a passive income, and I just don't think it meets that test. Rents are considered passive by the IRS, and they're taxed in a different way than active income. But if you own that house yourself, even if you have a property manager on it, it's really not passive. If something goes wrong, they're coming to you saying, hey, we need some money to put in a new water heater, or now we have an insurance claim that you need to handle because there was a flood or something. Maybe that was the old water heater. And so just understanding like owning direct real estate as the managing partner, as one of the managing general partners, it doesn't meet my definition of passive income. And so the next opportunity would be to passively invest in somebody else's real estate deal or somebody else's real estate company that owns real estate. So that's really what you're looking at in your self-directed IRA is they can invest in alternatives or private market, whereas your traditional IRA custodians can only invest in public markets. Any questions on that, go ahead and pop them in the comments, either on LinkedIn or YouTube, and I will go ahead and answer those just as they come in. So what we do at Rise Capital specifically is private lending. So every private company will have a different thing they do. You might have a friend who has a tech startup and you want to invest in their tech startup. I've invested in some privately held professional sports teams and some private companies. I invest in a variety of different private investments. Most of what I do is real estate because that's where I feel the most competent to make decisions. And so I tend to be more heavily exposed to that because I really do understand that business model. So we have some public stuff, we have some non-real estate private stuff. And we're going to talk about real estate. Could be an apartment complex. You could be buying into a storage unit. You could be buying any commercial. You and a group could you buy into residential real estates as a group. There are all sorts of ways that of real estate investing. And there are many, many ways to invest in real estate. So it's really easy to diversify in the private markets because you could say, okay, I'm going to have a little bit of self-storage over here, a little bit of private equity in a tech startup over here. And so you're able to diversify very well. And even inside real estate, you can diversify very well. So private lending is basically you are loaning someone money to run their real estate business. And you could do a private loan to any private business. There are networks where you can put a request out there as a business owner. I need a new forklift for my warehouse, and somebody could loan you the money to go buy that. Any kind of private loan, but what we do is specifically for real estate loans. So if you've heard of flipping or rehabbers, where they purchase a home and then they fix it up to put it back on the market. They're not living in that home. We actually cannot lend to people who are owner occupied or live in flip. We can only lend to homes that are not going to be owner occupied. So they'll purchase that home and they're looking for a loan. It's basically a mortgage that we're making, but it's not going to be your 30-year fixed rate mortgage that you would normally get if you were going to move into a house. It's going to be a very short-term type of note. We do ours in increments of 6 months, and sometimes we'll do a 6-month extension. It just depends on the borrower, the project, what they're expecting, but we do our notes in 6-month increments. And then we offer those notes out to our investing network so that they can get into those notes. And that makes the barrier of entry much lower. If you've ever looked at doing any hard money lending, hard money means that it is secured by the asset, the hard asset. It's not secured by the borrower. So normally when you're going to get a mortgage, you would go through an underwriting process where they want your W-2s, all your tax returns, you want bank statements. They're really going to underwrite your financial situation as a borrower to see that you can perform on this. What we're looking for is we want to know if the property can perform. So if the worst happens and we need to take back ownership of that property, basically a foreclosure, that what we can do with that property will then allow us to pay the investors back. So we need to make sure that the property is always worth more than the loan itself, and that it is a property that we would feel comfortable taking over if we needed to go in and finish the flip. We haven't had to do that yet. We hope we never have to do that. But it's always something that we have a contingency for, just in case. Is it close enough we can handle it? Is it the type of construction project we've done before so that we can get it back on the market? And so we focus more regionally, and we're able to say, if I had to take this property back, could the property perform to make good on the loan itself? So private lending basically just means loaning people money, but not in a public way. Again, public credit is like corporate bonds, things like that. Private credit is also to businesses, but the
Aloha, everybody. We are very sorry for a bunch of technical difficulties here.
Drop it. Drop it. Drop it.
Give me a quick
Drop
second.
it. Drop it. Drop it.
Okay, Sasha, it is up to you and us, you and I. Thank you for popping in. We are live. We lost a few people, but hopefully we can kind of kick it back up. Emma's having some trouble with her service, so we'll go ahead from here. So she left it off at kind of private lending. Let's just go back and forth. Zasha, you're on, so let's just do it. Give the crowd, whoever's here, kind of some understanding of what private lending is, because you've done some from your aspect, and then I'll jump back in and take it over from my aspect of it.
Hello, everybody. Aloha. I'm glad that we got it up.
We have more technical difficulties.
Oh, can you hear me?
Oh, wait. You probably have sound. I have my sound off.
Can you hear me now?
That was my side. Yes.
This is all a part of it. You know, we just go with the flow. Okay. So for private lending, majority of people, especially when they are first getting started in investing, they think it's something active. I wish I knew more about private lending myself when I was working my job as a civil engineer. So just a little bit of background about me. Aloha, Zasha Smith with Rise Capital. I started off in 2019 fixing and flipping, and then more recently moved into the more passive investing space, started private lending, and then started a fund with all these amazing people, got into commercial real estate, and now do this full time. Quit my engineering job, became a fund manager, and really just helping other people invest passively and buy back their time. So with private lending, especially through our fund, if you choose to invest, by partnering with other people, it's a lot more hands off. And what it basically is when you take your money, you invest it into somebody else's real estate project. They do all the work. You're in charge of course, deploying the capital into it. But I mean, other than that, you don't have any real roles or responsibilities in the project. And so that's what I like about it a lot. Coming from the fix and flip space, it's a lot of hands-on work. Even if you hire out people, there's a lot of challenges that come with it. There's a lot of time. And especially even when you own rental properties, I have property managers for a few of my properties, but I still have to approve different fixes that come up. I still have to coordinate with them if there's any renovations that need to be done, or any big things that come up with insurance, which recently I'm dealing with a lot. So private lending helps bring in another source of more secured, reliable cash flow, I would say, versus, the active investing side. So we help a lot of people basically use their money to make more money.
Yeah, that's awesome. I think I see Emma back in. We can let Emma back on. She's the queen of everything. And we'll stay on and kind of help you navigate through it all. But let me just kind of give a background to it. And Emma was kind of talking about this, and Zasha kicked up on it too. So why lending? I mean, we do commercial assets as well, but there's different aspects of it. And Zasha brought it up. So reliable cash flow is one of them. When you're looking at, and we're strong proponents of diversification. You heard Emma talk about the equities market, and some of her money's in the equities market. Some of my money's in the equity market as well, and I want to actually push a bit more money into the equity market, depending on how everything looks. But diversification is big. Even when you're looking at like real estate, and it's one of the underlying things of why we structured the fund the way we structured it is for that diversification, because you're going to have cyclicality in any kind of market that you're in. I mean, you see different, if you guys watch the stock market, you guys see different stocks that are, I mean, they were still doing phenomenal from the annualized standpoint, but now are starting to get compression on their overall returns. And in the last few weeks, you've been several stocks have been negative. So you're just, there's the ebbs and flows with uncertainty. And the same thing happens in real estate. You're going to have cyclicality in real estate as well. So when you're diversifying, and Emma talked about it as well, is diversifying into different types of assets as well as geographic diversification is a strong point to be able to not have all of your investments all in one market. So you want to try and diversify in that aspect as well. But the private lending side of it offers us, like Zasha said, reliable cash flow, which is really important to what Emma started the whole entire presentation out with, is if you want to try and retire and you want to try and live off of that income, you need something that's somewhat reliable. I mean, unless you have a large nest egg of money sitting on the side, which is great, but still, you'd still want to diversify. At some point, we'll kind of share with the group on like what the ultra wealthy will invest in, and they'll always invest. I mean, just look at Warren Buffett, right? Everyone knows who Warren Buffett is. He's the largest owner of treasuries in the entire United States, and treasuries are, again, I mean, it's kind of, I like to look at debt, the debt that we do is sort of like that, just on a higher return level. I guess, like Emma was saying before, the money that we have is secured against the asset. So if something happens, we still have the asset. Like we can, again, we don't want to, but we could foreclose on the property and still keep that asset. So that's kind of why we do private lending. It's cash flow. Your money that you're investing is a bit more secure. Again, when you guys kind of educate yourselves, a really important thing to educate yourself on is not only returns and how to understand the returns, but the risk that you're taking on with each one of the investments, because there's different risk. And that's why you're going to see, all you have to do is Google top 1% wealthiest people in the world and their investment allocation. And you'll see a bunch of graphs on it that will kind of show you the diversification. And a large portion of that is in real estate. And a large portion of that is typically going to be spread out between like physical assets, like Emma talked about, and then debt assets or assets that will give you consistent cash flow and take it on lower risk. And normally a larger percentage of their portfolio, and when I say larger percentage, I'll say maybe like in the private markets, they'll have 30%. I mean, there's a bunch of information out there and they're all a little different, but they say hypothetically 30% in private equities, and in all of real estate, there's maybe another 40%. And in that 40% real estate, they'll have maybe 15 to 20% is in debt aspects or private equity debt. So super interesting. Sorry, we took a lot. I'll let you come back and I'll stay on just in case you get cut off.
Yeah. Fortunately, I'm married to my IT guy and I bring him everywhere. So he thinks he fixed it, but we'll see. Stick around just in case that he didn't fix it. I did want to add kind of one thing to what you were saying there. I do kind of want to point out like some of these photos here, especially if you're watching. These are all real photos of us. Like Zasha lives in Hawaii, so basically her entire life looks like a vacation. But her ability to leave her engineering job when she was quite young and pursue real estate full time, real estate was still her active income at that time. But at a certain point, it becomes a new job, a new business. And one of the ways that when I first met Zasha, she was looking to diversify passively. So when you're talking about diversifying geographically, it's also important to think about diversification across how much time you want to spend on something. So what you're an expert at, be an expert at. Make good money doing it. And then think about what can I invest in that I'm not an expert at that I can passively spend my time on less. And then even I still invest hard money with other funds just rise because they might be investing in a different geography. So we're really big fans of diversification, both actively and passively. Well, I don't think I diversify actively. I like to just really hone in and concentrate on the active thing and then diversify on the passive side. All right. So using your IRA for real estate investing, that's me up on Mount Olympus outside of Salt Lake City. Just an amazing view. And then this is us hiking the Arizona Trail with the family. We took 3 months to basically go backpacking. I mean, that's the private the passive income dream right there, is to say, I want to take 3 months and go do this thing. And we were still kind of checking in. We were just launching the fund at that time, kind of at the top of a mountain on Wi-Fi, when we could get a signal from the cell phone, and trying to participate as much as we could. But we're out there trying to show that passive income is a real thing and it really can change your life. And I think that's one thing that differentiates Rise from other companies. Like, we're already doing it. We all have already left our jobs. We're surviving on our passive income and then growing a business because we want to either grow our, or because we want other families live this dream and live this lifestyle. So just wanted to point out some of those photos. There's Sasha again hiking in Hawaii. So we're talking about private loans inside your IRA. So I'm using private loans as the example investment inside of an IRA. Again, you can use a self-directed IRA for any private market or alternative investing. So you can really diversify inside of that as well. If you're going to have some of your IRA in public markets, you would leave that with your traditional custodian, your Schwab, your Merrill, your Robinhood. Most passive custodians, I don't like to call them passive custodians because we're talking about passive income, but really what they are is they're not telling you what to invest in. They're not offering you mutual funds. They're not offering you options. They literally are like, we're here as a custodian because you're required by law to have a custodian for your retirement account. We don't tell you what to do. We just make sure that what you're investing in is according to regulations, that you're not self-dealing and you're not investing in things that are prohibited, like life insurance or other kinds of some collectibles, wines, things like that you cannot invest in. There are a few rules and we'll get down to that later. But just your custodian, your passive custodian is there to just make sure you're following the regulations, but they don't give you investing advice. They don't tell you what to do. So this really does apply to everything, but we're going to use private loans as the example because private loans specifically have a different way of being taxed, what I think is really important here. So interest income on a private loan is considered active income, and it is taxed at your ordinary rates or short-term capital gains rate, or however you want to refer to that. And so it's important to think, if I'm going to be earning active income or ordinary income, that's going to be taxed as ordinary income, I want to do that inside of my retirement account. And so especially if it's a Roth IRA, you really are not going to pay taxes on those interest rate or those interest income because you have it in a Roth and you're not going to pay taxes on those gains. If you're in a traditional IRA, it's a little bit different. You still will pay, the tax when you withdraw it. So you kind of have to figure out like which way you want to go with that. And can you do a Roth conversion and all of those kinds of things? But just to say, like, let's just pretend we're in a Roth and you're earning interest and you're not paying any taxes on that. So most of your investing into private loans, you would want to do through an IRA. But again, what we talked about at the beginning, what about 50 to 59 and a half? How are you going to live there? So there should be a certain portion that you're, again, I'm not a financial advisor. I'm not a self-directed IRA custodian. This is just me as an investor sharing my experiences with what we and our team have found as we're doing this. It's important to have some outside of the IRA that you're investing in cash so that you can have reliable income during those gap years between when you actually leave your job and you can start accessing those retirement accounts. So this is another way to diversify in a way to be able to say, okay, I'm going to have this income steadily, reliably earning me from 59 and a half, but I also have to think about doing some in cash outside of that as well. So you have to understand that the tax efficiency comes with doing it inside the IRA. The tax efficiency doing it outside the IRA needs to come through other forms. Two of the most popular we like to talk about that are not in this booklet are the real estate professional, meaning you are doing real estate full-time, you own properties that are depreciating, and you can use that depreciation to offset not only your passive income, meaning rents, but also your active income, and in this case, meaning your interest. Another popular one are oil and gas credits, and those are kind of it for most families to be able to offset your active income. I know there are a few other options, but those are the two big ones that we come across. We are all personally real estate professionals, and we like that credit. But I do know some of our investors who are also doing those oil and gas credits to offset their cash investing. So I just want to put that out there as something to consider and talk to your advisor about. And also making sure that your advisor does advise on private markets. Most advisors are really only experts in the public markets. And so if you want to come to your advisor and say, can you help me find these types of private market opportunities? And they basically don't have any expertise there, they don't have a network there, or it's not something that they can sell or get commission for. So make sure your advisor actually understands private markets. And if they don't, you might need to look for a new one who can help guide you through this process. All right, how to get started. So this is a flyer that we sent out to our investors. It goes over the time frame, short-term loans, commercial. Again, they're in 6 months increments, but sometimes commercial will run a little bit longer, 12 to 24 months. But residential typically is in that 6 to 12 month range. You can see the return on capital is 10%. If you are investing more than $200,000 into a particular deal, then you would earn 12% on that money. And then you can reinvest those gains for compounding, or you can withdraw them either back to your IRA, or if you're investing in a cash account or a taxable account, you could withdraw that back to your big account and use that for living expenses or whatever you want. The debt position is really important to understand because this is part of the risk profile. You want to be as deep down the capital stack as you can, or at the bottom of it. So imagine that you have a house and you don't pay your mortgage. The bank will come and take your house. So the bank owns the first lien on that house. If you go and get a HELOC on that house, the HELOC would have second claim. If you stop paying the HELOC lender can come and put a lien on, or foreclose on your house. And so if you have stopped paying your first mortgage and you've stopped paying your second mortgage, and the first mortgage holder will take your house basically, and they'll sell it at auction or whatever that particular company will do with it. Any money that's made off of that goes to pay off the first lien lender, and whatever's left over goes to a second or even a third lien lender. So the farther down that capital stack you are, the better. As a homeowner, you're considered more like common equity. That's what we would call it in commercial real estate. So you have an equity stake in that house. That would be your appreciation or any improvements you've done to the house or money you put in. That's equity that you've built in and you own that, but it's unrealized. And the lender can take that house away if you default on that loan. And so it's important to understand, if you are a lender, you're going to be safest in that first lien position. The second lien position is less safe. Usually it charges a higher interest rate. We don't do second lien loans. But there is something called mezzanine loans in commercial real estate. That is a second lien. So you have a senior lender, and then you'll have the junior lender who's bringing in a portion of the down payment that the senior lender is requiring. It definitely increases risk, and usually the interest rate is higher. We haven't done any of those yet, but maybe someday we will. Loan to value, again, is another way to evaluate the risk of a deal. So we like 60 to 70% loan to value. And that would be the value that it would be after it's repaired. So if somebody's buying a house that's going to sell for, say, $500,000, but they're only paying $300,000 for it, but if they fix it up by putting $100,000 into it, maybe they could sell it in another $600. Maybe they could sell it for $700 or $750, right? So we'll go off of that $700 or $750 as the percentage, the loan to future value, the loan to improved value, or the loan to after repair value. There are a lot of ways to say that. So looking at the lower the LTV is on a loan, generally the safer it's going to be, because you could probably take it back. Sometimes I just put it right back on the market. Not that I've ever taken a house, but sometimes I'll get a really great deal on a house and I actually don't fix it up. I just clean it up and just put it right back on the MLS. And so there's an opportunity, if the house is a good enough deal on the front end, that you don't even have to fix it up. So obviously, if it's mid construction, you would want to complete that, right? And that's where the construction experience comes in. I personally have a commercial multifamily portfolio. We have done very heavy construction projects on those commercial properties. Zasha and Chris, both flipping properties. And the house that really started it all for us was our house that we had in Austin that we bought. It was abandoned in really bad shape. We completely gutted it, added onto it, changed the floor plan, ripped out all the plumbing, ripped out all the wiring, and managed our subcontractors and managed the project, did a lot of the work ourselves. And so the construction experience of the people that you are loaning money to is very important. That's the flipper. But the construction experience of us also matters, because if we ever had to take over a property, you know that we're capable of doing it. We don't just end up with it and say like, okay, now what do we do? And we make a mess of it. Also, one of our partners, Harmony, is a real estate agent in the state of Utah. And so she is pulling value comps when we're running these things. She would be the one to be listing it. And so it's an ability of us to take the project from cradle to grave if that's what we need to do. So we always look at a project as if we need to take it over and hope we never do. So that's an example of the type in your IRA. But we just want to say,
Not sure we're back on.
We're the backup singers.
Yeah, we're definitely this for educational purposes. We lost Emma again, and we probably will not keep this one up on YouTube. There's way too many off and on. But so she's looking at different types of regulations. You have a retirement account. I mean, let's just kind of go through that, some of your experiences, and I can go through and talk a little bit more about the regulations. She covered a bunch of them, but we can kind of go through this and go through some of the regulations. But maybe talk through, for the few people we have on, talk through some of your experiences through your investing in your IRA and how that came to fruition.
Yeah, so for me, at my engineering job, I had a traditional 401k. And when I left my job, I didn't even think about it until I started raising money for my projects and realized that people were using their retirement to invest into my deals for private lending purposes. So that got me to thinking, wait, I think I still have a retirement at my old job because I wasn't really actively managing it. And so it's crazy that there was $107,000 in my traditional 401k in 2020. And then when I went back to check on it in 2022, it was down to, I think, less than 80,000. So in 2 years of not watching my retirement funds, I lost 20 grand. So that was a big lesson for me. And I know now how to invest my money into real estate to basically get a more secured return. So I ended up rolling it over into a solo 401k, a self-directed one, because I am a business owner. I don't have employees. And there's some other, stipulations as well. If you talk to a retirement specialist, they can help kind of steer you in the right direction of which one applies to you. But for me, I like that I have checkbook control, so I can invest in anything, the projects that I want to invest in. Of course, I have more of a decision making on where I can put it. So I like that as well. I know what my average returns could be if I did invest it into the stock market. I know what they could potentially be investing into real estate. And so I choose to now invest the funds into other, people's deals, because I can't invest into my own deals or deals that I am managing myself. So it's been a great experience for me. I think you have to want to also be able to oversee where you're investing it into. And I think the key thing for me is trusting the people that I'm investing with, that they'll keep open communication with me, that I'm investing into something that is like, quote unquote, a good deal. So being able to look at the properties I'm investing in and determine if it's a good area, if it's a project I want to be a part of. But for me, in this stage of my life, as I advance as an investor, I really want to invest in projects that will are more stable and will give more set returns. So I'm investing in areas that I know too that are would essentially align with my goals. And so for me, I like to invest into debt deals because they are shorter term, anywhere from 6 to 12 months returns. And then I also, when really good equity deals, as far as like apartment projects come up that are 3 to 5 year holds, I'll invest the money in there as well. I think the key to all of this is just diversifying and putting money into different investment vehicles because, like I said, like any investment is a risk, but you want to try to mitigate that risk as much as possible. So using tax deferred accounts as well as I put my $100,000 into a real estate project. When that return, I get that back, I put it back into, it goes directly back into my retirement account and the interest as well. So that potentially does not get taxed. So I like that aspect of it, unless I pull it out directly. But basically I'm using it as a vehicle to then loan out this money, have it make more money, and then put it back without paying taxes. So that's been a great experience for me.
I'll kind of just go through, not necessarily my experience. I mean, I did a bunch of rollovers as well. Normally, this kind of talk through more of some of the fundamentals. And Natasha, if you had like any questions or things that pop in your mind, we'll only have a few more minutes, so I'll try to make it relatively quick. But there are a bunch of different options. But I think one of the big things, and again, we are not tax professionals. We're definitely not, well, we have some licenses, but we're not licensed attorneys or CPAs. So definitely go consult your tax professional for help. But IRAs are basically just trusts set up with the exemptions that you heard sort of Emma and Zasha talk about. Emma's back. So let's kind of just wrap it up because we only have a few more minutes, but let's just kind of talk through what the different, I mean, obviously you have it here. So let's talk through the different types of IRAs and the different accounts. So a self-directed is really no different. It's still a trust, and it basically sets it that there's language in the documents that allows you to basically direct your investments how you want to direct your investments. And Emma talked about that a little earlier. So you gotta, one of the big things is think about it, especially if you're going to self-direct it. You have to think about it, and especially if you're like Zasha, where you have full checkbook control, so you really don't have a custodian overseeing your investments. You really want to be careful because you still want to, I mean, the whole reason you have, well, maybe not the whole reason, but one of the benefits of having an IRA account is the tax benefits. So you want to be able to maintain that tax benefits normally. I mean, there might be use cases where you don't care and you don't want to. There's also use cases where you can roll over money from your traditional IRA to your Roth IRA for even more tax advantages. But you kind of really got to know that it's treated like it's a separate entity. It's like a completely different person, and there's really not too many assets that you cannot invest in. There are a very small handful of things that you cannot invest in, like insurance and art. There's a very small list, so you can pretty much invest in most alternative assets. The biggest thing you have to understand is who you can invest, well, who your IRA can invest with. That's probably the biggest thing, and I'm sure we'll have another episode where we're kind of talking a little bit more about that. But I will kind of turn it back over to Emma because she came back on, and have her kind of wrap it up for everybody.
Yeah, now I'm hotspotting in on my phone, so we're making it work. I think, I don't know, maybe that's a metaphor for how we get stuff done. We just figure it out and you get it done. So any type of account that you can have a traditional IRA, you can also make into a self-directed. So the HSA is a big one. People always ask me, oh, have you left your job? How do you do this? You get a high deductible plan, you open up an HSA, and then we use that HSA to be self-directed so that we can grow in there. And then we use that for our expensive medical coverage there. So there are lots of options here. Any kind of tax advantaged account that has an investing component to it can be used as a self-directed IRA, basically. So even the educational savings plans, if you have control over those coverdels, things like that. So just get a little bit creative. You probably got a lot of money scattered around in different places, and you want to be able to make your own investing decisions with that. And so sometimes people don't recognize like, oh, wish I had more money to invest, but you might in some of these other accounts, and you can self-direct all or most of them. Not all custodians will do all of these accounts, but many of them will do most of them. Allowable assets. So this is kind of what I was talking about earlier. You cannot invest in certain types of things. Traditional only offer things like stocks, bonds, that kind of thing. But passive or self-directed custodians leave all the investing decisions in the investor's control. They allow a wider variety of assets, namely private markets. They do not give investment advice. They only hold the capital, and they ensure that the transactions are not prohibited. So these include traditional and alternative investments, real estate, most precious metals. I think there are some coins that you can, but like not coin collections, like certain kinds of US coins, crypto. I mean, the sky's the limit. These are the exclusions. Direct ownership of assets. So you can't go buy a rental house in your IRA and then manage that rental house. You could buy a rental house in your IRA, but you really cannot be managing it. So you have to have a property manager in there, and you really need to make sure that this is an arm's length type of transaction, that you're not self-dealing. So you can't directly own or manage the assets. And there are some rules there. Work with your custodian to make sure, because there's some fine lines, some gray area, and just make sure that your custodian has approved anything that you want to do inside of your IRA. So no self-dealing, illegal. Obviously, you can't open up a business inside of your IRA that deals in illegal substances. That should go without saying. But disqualified individuals. So you can't say to your husband or your dad, "Hey, you go buy a rental house, and then I'll invest in that." There are certain people that also count as self-dealing. So illiquid collectibles, some kinds of art, some kinds of alcohol, firearms, gems. You can also take out a life insurance policy with your IRA. I'm not exactly sure why that one's disallowed, but you can't go get a whole life or cash value life insurance policy on yourself and use your IRA to pay for it. That is disallowed. Different kinds of S Corp entities. So just consult with your custodian. There are a few things you can't do, but most privately held assets you can hold inside of your self-directed IRA. So the setup process. Zasha alluded to this before. You have two options. You can either have a custodian control the release of funds, or you can control the release of funds. This is basically called a checkbook. So you open up an LLC that has a bank account, and you can release those funds. That is important if you are funding, say, like a flipper, and you're doing direct private money loans. So you're going to find your own flipper, you're going to send them the money, and you're basically going to run your hard money business through your IRA. You're lending it out to them to run their business with. So I think that's a little bit of a gray area, honestly. But if you're doing direct private money loans, then you would be
If you did direct money loans, you would be frozen if you're just trying to do direct money loans. I don't even know where she was going with that. I'd say we can kind of come. We're at the hour. We can probably wrap it up. If you guys want to get to understand or know, was that you moving the page, or was that her?
Might have been her.
Oh, okay. It looks like she's going to the end. The biggest thing I think the biggest takeaway is there is options. Try to learn what those options are, and that's where we're trying to help. I just seen her pop back in. We're wrapping it up, Emma. Try to learn what your options are. There are a bunch of options out there. Reach out to us if again, or your financial advisor. As Emma said earlier, try to make sure your financial advisor understands alternative assets, because again, all you have to do is go research how the ultra wealthy invest, and they invest in alternative assets. A gigantic portion of their portfolio is in alternatives. So go ahead and research that. If you guys want to get in touch with us, we can help you, kind of guide you more on what your options are. We have partners up with different self-directed companies that can kind of help you on your journey there as well. And then we have a cool calculator. So someone put the link in the YouTube. If you guys want, go to that page, and you can kind of calculate. It kind of helps you design what you want your life to look like, and you can kind of set your terms on the amount of money that you have, the amount of money that you want to invest, what you want your investment life to look like when you go to retire. And I mean, it's really designed to kind of help you navigate what you want your life to look like, and then kind of reverse engineer it. So you can kind of figure, okay, how much do I have to invest and what do I have to earn on those investments? So it can kind of help you critique your investment, and even go back to your financial advisor if you have one and say, this is what I need to hit by the time I'm whatever age it is for you. And how do you help me get there? And again, I would try to strongly look for a financial planner or advisor that does understand alternative assets, because again, it can be a larger portion of your portfolio and typically will yield significantly higher returns. So thanks, Emma. That was awesome. Hopefully the next time
Thank
we'll
you
do
for
this,
rescuing me.
we have great internet service. It happens to me too. It happened to me once where I just actually cut off and left. So I get it. It's technology.
We're just doing the best we can. And I'm so grateful we have this technology, because years ago, everything was face to face, and having this online community allows us to diversify even more than we have ever been traditionally able to do. So, sometimes it comes with hiccups, but overall, it's been a huge blessing for us. And it's not just because my husband worked as an IT guy for many years while I was building the real estate business. Join us next month, every other Thursday. We have either a lunchtime meeting or an evening meeting like this one, risecapitalinvestments.co/webinar. And we will be having Nate Hare from Directed IRA come and teach us some of the intricacies, the details of actually opening up one of these accounts. And if you would like to open up an account with Directed IRA, we have a great discount code for you there. We don't make any money off of that. We just negotiated a little bit of a discount on your first year's fees. And would love to share that with you. Just reach out, partnerwithrise.com. You can put / any of our names at the end of it if you want to get into touch with one of us in particular, or just partnerwithrise.com and try your luck. It's like a roulette wheel. Who's gonna go there when rise.com? But you can get a hold of us directly as well. So thank you everybody for coming, and we will see you at our next event. Zasha, can you remind them of the date for the next live, the Lunch and Learn?
So we are having a live on March 6th. We're actually going to be having a meetup as well if you are local to Utah, in Salt Lake City at Legends on Monday, March 3rd as well. It's an in-person. You get a chance to meet us in person. I believe it's from 6 to 8, but it will be on our website. Partner with Rise.
Flying in for it, so she'll be there in person as well.
Yeah, and then we'll have our next virtual LinkedIn Live on the 6th, covering the best ever conference that's happening there as well. So make sure you stay tuned. Thank you for those who joined and just went with the flow of technology. We do appreciate your patience, and we hope to help you on your real estate investing journey.
All right.
Awesome,
if you have any
guys.
questions, jump on our calendar, and we will see you on the next one. Thanks, you guys, for the bailout.
Aloha.